Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, April 5th, 2023. It is 12:32 p.m. Eastern Time, so I'm starting the video. So we're about halfway through the trading day, and I just wanted to do another update primarily on the equity markets. Those have come pretty frequently lately, and I've been pretty persistent on where I think things are going, or consistent, I should say, or both. And I tend to do more frequent updates when it appears to me there's maybe an opportunity, a big move coming. We'll see. A lot of work to be done. Well, maybe not. We'll see. More so in price than in time. We'll get to that in just one second. But here's what I'm going to do. The usual. Start out with the equity markets, and I'll continue my I've been hyper focused or primarily focused on the Nasdaq 100. As in most points in time, not all points, but most point in time, it's all about those market leading tech stocks, and varies so much lately. They've by far, took they caused the outperformance of the Nasdaq 100. The Nasdaq 100 has considerably outperformed the equal weighted Nasdaq 100. Same thing with the S&P 500 and the equal weighted, and that shows what I've been highlighting is that money has been moving into these fangs. For me, and I'm doing the video, I think it's just one of, we could be looking at one of the, the best shorting ops, as I said, I think a few days ago and over the past week or so. One of the best shorting ops by far all year, and possibly one of the best shorting ops throughout this bear market. Everything's aligning for me. I keep talking about, you're hearing me talk more and more about fundamentals. Obviously, technicals always come first and foremost in my book, but the best trades, in my opinion, swing and trend trades, long-term stuff, come when both the technicals and the fundamentals align. So I'll talk on that a little bit. I'll I'm going to include the semiconductors, because that's also very closely related to the Nasdaq 100. Almost all the semis, most of them are in the Nasdaq 100, and they're tech, and they're really a subsector of tech, and tech is all of, not all of, it's over half of the Nasdaq 100, and it's over a quarter, by far the largest component of the S&P 500 as well. And time permitting, I'll do a brief update on, I wanted to just add some comments on that XLE short trade that I got out there yesterday. And then I've had a few requests for natural gas lately. I put up the charts in the comment section both yesterday and today. I'll get to that if time permitting. And then the whole commodities thing that I'm talking about lately. Okay, that sounds like a lot. Let me just rifle through there, because most of this just updates on the existing charts and things I covered, so I can go a little faster there. This is the Nasdaq 100 Futures NQ. You have a big level, color coded at yellow, 13074. However, this is probably the level that I should have colored up, and I'll tell you why in a second, because this closer aligns with the comparable level on QQQ. In other words, I had 13704 highlighted because it was this reaction high, almost to the button, hit it again, consolidated on there, and then broke out. And we failed that today. So that was, and still is, as I said earlier, I think an important level. I had a potential trend line here, but I'll tell you that trend line really wasn't confirmed, because we had very little, if any, reaction. We moved through it. I added that today. But let's with that being said, that's why I do these videos on a daily basis, because charts are dynamic, I always say, and therefore so is my analysis, constantly changing. There are a lot of reactions also on that 12973, and it's what, I had it, that line here, it's really a resistance zone. You have reactions there, reactions there, and there, and there. And so that is the big level. That's really what needs to go to get this party started to the downside, in my opinion. And it is support, and this is the biggest pullback in at least a week or so. And the dip buyers have been voracious lately. So, I would be surprised, not shocked, but surprised if we didn't get a reaction right here. Let me show you the 5-minute chart. That's I got out to you today. This is one I covered in the video yesterday. Said to break at that level and explain the reasoning. You have the volume price histogram. That's where the majority of the buyers over the last week or so bought in this area here, as evidenced by the volume price histogram. And so therefore, I said if we took that out, you'd likely see this, and that's exactly what we saw. And that is because that's where the stops are placed. It's not one level. Everybody's different. Everyone bought at a different price in this range. And everyone uses different stop loss parameters, some wider, some tighter, but that's what happens when that occurs. So far so good. And again, this is the realm of the active trader. So if you would have let's see what time it took that out at this morning, 9 a.m. or so you could have jumped on that easily. And even if you're a futures trader and you go to bed and it was 3 in the morning, you can do a sell stop order. Sell stops and buy stops are when you don't have a position, you put an order in. If it drops below to short, you drop below a certain level, that'll trigger a sell stop and get you in short. Likewise, buy stops are good for breakouts and also in regular session for swing traders that don't have the time to be in front of the computer all day. Let me show you a couple other things. Let's look at QQQ. So this is zoomed out, busy board here. I know that. I'm just going to show you real quick, and then I'll turn off all the lines or zoom in. You'll see it a little better. 312.62 is where I have the line. It is, to me, a big level. There's a major, significant reaction high, by a high where you reversed, had a big pullback, then you rallied up and you took it out there. And if you can see closely, after you broke out, the Qs back tested it, came again, back tested it again, and then this whole thing, that breakout, as you've heard me say once, you've heard me say it a million times, breakouts that occur with negative divergence typically fail. They have a much higher rate of failing. So you had a divergent high, you had the little pullback that gave us the back test, and then the divergence extended. So when I say DH1, DH2, that's an extension of a previous divergent high. So the first one did play out for a correction, but that correction was the one that gave us the back test. That made the bulls salivate because that's TA 101 says you either buy a breakout, or if you missed it, you buy a back test if you get a back test of the breakout. And so at that point, that blew out undoubtedly a lot of shorts, but they use pesky little divergences, right? And so it sent it back down for yet one more back test. The dip buyers bought again, but then they got smoked when the breakout failed. So that's what you're looking at right here. That's the point of failure. And as I often say, fewer things in trading are more bearish than a failed long side clear breakout. And that sent us way down. We came back up, tried to back test it from below, rejected, and the whole thing from high to low was a drop. Once that breakout failed, the Nasdaq plunged 19% from this failed breakout right here, once the breakout. So as I've been talking about, I suspect that this breakout will fail like that one, but we'll see. I can tell you right now, if you are a glass half full person on the markets at this point in time, meaning bullish, what I'm doing in this video is I'm going to show you two things. Well, I'm going to show you one thing, and that are the levels to watch. So if you're bearish, these are the levels that will give us additional check marks and could provide additional short entries or add-ons or new short entries if you're not short, if and when these levels are taken out. Likewise, if you disagree with me and you think the market's going much higher, the same support levels that will trigger sell signals if broken are the support levels you want to buy to. So I can say this: if you are bullish, just because that last breakout failed and just because this one has divergence, sometimes, as I say, often breakouts that occur with negative divergence fail, but not always. I've certainly seen my share that went on to power through those divergences. So if you are bullish, again, the takeaway is I'm going over key support and resistance levels where you can step in and buy. And again, the bulls, quote unquote, should be buying these levels. And the way it works for me, if and as each support level gets taken out, clearly taken out. Not, we've seen whipsaws are almost to be expected nowadays, but that's why I said you increase the odds if you wait for a solid close. If you're trading a 60-minute time frame, a solid 60-minute candle close, it's going to get you in a little later, but it's going to increase the odds. So you decide where you want to. Everyone's, again, I get a million levels. There's no one entry. These are multiple entries, and let me just zoom in. So you can see the level, and you had another rally to it right there off that low, divergent low, divergent low, divergent low. Boom, got rejected, fell back down, made a divergent low here, rallied up, and this is where we zoom in tight. So this is the level I've been focused on. And there was Fed day right there. Remember that purple circle is the Fed range. These two candles, Fed FOMC announcement came at 2 p.m. as it always does. You had two hourly candlesticks left. One went up, the other went down. We had that range, and then this box, we broke above the range. And when we're in the box, I said, look, a solid break below or above will most likely, a solid break below would be bearish. What you had is a little whipsaw. You've had a considerably bigger break now. And so the way I see things is that, and I haven't wavered on where I think things are going, and that this is still going to fail. So you might say, well, Randy, that's a little bit, confirmation bias. You said if we go up, we keep going up. Because, and as I maintained, everything I'm looking at, both technically, meaning we still very much have. We had a divergent high here. We had even bigger divergence here and even bigger here. The same divergence. It's only gotten bigger. Therefore, that indicates to me an even bigger drop is likely coming. And also the fact that we've done this now since the Fed, and we went down and we went back up. I believe that this has cleared out a lot of short interest, cleared out a lot of bearish sentiment, and undoubtedly, the few times I turn the TV on, I'm reading articles, the vast majority of these, market pundits and money managers, they're bullish now because we're above the 200 days and markets are going up. It's in an uptrend, and therefore, if this breakout fails, that's a much bigger and longer sustaining. We've been above the breakout point for longer. If it fails, to me, that's going to be very, very bearish. And not by just a day. Again, it's more of an incremental thing. It's not all or none, where if you drop below 313.62, the market crashes. Again, the further you get away from there, it just increases the odds, that's all. So the only thing I've done to the 60-minute chart since the last update is the uptrend line, like I just showed you on NQ. And that comes in right here with that 313 support. I would prefer to see a little bit of I would prefer to see a reaction here. Now, I define a reaction as one of two things or a combination thereof. A reaction when you're going down to support, a reaction is either a bounce or a pause where you consolidate on there. And so far, you can see market hit a low around on that 11 a.m. candle. It's been moving sideways. So this is so far a reaction. It's very minor, but enough. And if we got a little bit of a bounce, all the better, but we don't have to have it. And again, it doesn't change what this is. That's even better support. This is just what, by my minimum definition, is a trend line, because I always say any 2 points can be connected at random, so it takes that third distinct reaction to create or help validate a trend line. But again, trend line or not, 313-ish, 312, you want to be safe. You go to the daily chart. You can see my daily chart here. I have a line at 312 right here, and I'll color that up yellow. So I know it's like a Christmas tree. I've got my max potential bounce target zone. In hindsight, I should have colored this one red. This was from earlier in the year. That should have been red, because kind of the red zone for the bears, where if you take that out, it just really chips away. But this is where early on was my most likely bounce target zone, where I figured this rally would carry into. We hit the top of it a few times. And again, it was there for, it's not just a random box that I placed. It's placed on a key technical level, which was that, again, on the daily, it's 312. So let's go off 312. When you're going down and looking for a failure of a breakout, it's what I call the BOD support level, benefit of the doubt. My 60-minute chart shows 313 and change. Daily says 312. Well, if you want to play it safe, wait for a break of 312. And then, look, you've got plenty of room to come back to the 200 days, but I'll tell you my thoughts on this. Well, among many, I've already covered the long-term charts ad nauseum lately, so you know why I think we're still in a bear market with more to come. But here's what I see. The 200 days, it's not unusual to see them in a bear market, at least on maybe some indexes, not others, to take out the 200s. We already took out the 200s there. We got rejected. Remember, since the bear market started, we clearly on the Nasdaq 100 took out the 200s here. You back tested, failed, back tested, failed, back tested, failed, and here we took them out and then successfully tested. This is where, again, you on a scale 1 to 10, that's 10 for the bullish case. There's just a lot of other evidence that, again, there's, at almost any point in time I can make a bullish or bearish case on just about any stock. And so I see this, I recognize it. It may prove to be, what plays out and what prevails, but I think this is just that final kind of suck-in move, and I think it will fail. So my point is, we've already clearly broken out and clearly back tested the 200s and clearly moved away from them, right? So because of that, really, in my opinion, Qs have no business testing them again. Sure, it's possible, but usually I think if you get there, you're just gonna go on right down through with very little, if any, reaction on them. And there's also some key price support levels. That 294.20 is pretty big right there. Okay, so micro levels to watch. Again, 313, call it 312. On the 60-minute chart, I think 313, 313.50 or 60 will do the trick. And again, the further you get away from there, below it, it's these divergences that tell me it's baked in the cake. And I wanted to, again, get this video out because I think the potential is there for a much bigger move. I'm just focused on these small short-term levels. But if everything plays out the way I think it could here, and again, that's a very, very contrarian call, calling for what's pretty much amounts to a market crash, a big, powerful move down. When you're above the 200 days, when the technicals are bullish, the trend is bullish, again, the odds based on that are very low, but I think it's my preferred scenario. And it's also, again, it's also about risk reward. I told you I've been short since the Fed, and took a, no big deal. We're up from the Fed day. We rallied a whole 2.5% into yesterday's highs, above the actually even less than that. The spike high on Fed day was right there, and it was about a 2%, 1.96. So to me, that's nothing compared to the downside that I'm looking at here in the market. And again, these divergences, not only on the 60-minute chart, the daily chart, we need to get that bearish PPO crossover to firm that up. That's that. And then I'm watching closely, and been persistent on the the SOX semi-short. Most folks out there and the experts and everyone have been foaming at the mouth bullish on the semis. And today we've now moved back down below, not by a lot, but back below that 420, 460. Big resistance right there, big resistance. A lot of, it's capped it back here. Once you broke it, failed there, failed there. And again, we've gone through it a few times, a little to the upside, a little to the downside. You need to clearly get away from here. So we're below it now, and again, it's more of an incremental thing with each tick lower from where we're at today. It firms up the case. I'm going to show you in a second, but just a few ticks will probably do the trick. Here, let me show you what I'm talking about. Here's a 60-minute chart of SOXX. This is the December 28th high, or I'm sorry, low, reaction low. A nice clean uptrend line with 1, 2, 3, 4 distinct reactions were tested today. So very much a valid trend line. So really any more downside you can see here. Let me tighten it up. Actually, we're starting to crack it. This is, these trend lines always drift as I zoom in and zoom out. So what I wanted to do is tighten it up to all these candles right here. Little spike to close right back above it there. And that's it. So we have now, as I'm doing this video, as of today, we've just broken down and triggered a additional sell signal on the 60-minute chart. So this remains one of my preferred sectors short, on the short side right now. I've given you plenty of individual semis, both long and short trade ideas. Only really two. Well, Intel was the only one that broke out. AMD is still in that range, or no, Micron it was. But again, that's probably not going to break out. And And Intel rallied into that first target above the basing pattern yesterday, as I covered, and it's already down today. So semis across the board are down. Let me just go over those real quick, because this is, again, I think you'll get more bang for your buck. I heavily short the Nasdaq 100 because I think the FANGs have a lot of hot air to come out. Like I said, again, this is, I think it could be a generational, or one of the best shorting ops in years, not just in the bear market. There's just been this unfounded, and to me, I'm trying to wrap my head around it. The bid that the FANGs had, called it early in the year because the technicals were there, but since just in the last few weeks, how Microsoft, Apple, Amazon, how that's what drove the market. Everybody was running into those during the banking crisis, and I said this earlier, as if they were a flight to safety asset. And to me, that's just insane, because they're the ultimate risk-on assets, big tech, tech in general. And yet, so that's one thing that I just couldn't wrap my head around. They were buying the big FANGs. And then the other component is, I've been adamant, and the indicators are continuing to confirm it. We're finally seeing some pretty early but steady and increasing trends at the employment, the jobs market's rolling over, including today. And so a recession is imminent, yet this market, they were citing, just about everybody cited the rally since the FOMC meeting, that despite the fact the Fed said they were going to stay hawkish, the dot plot went down to Fed fund futures, what the market was expecting. So they were expecting interest rates to drop off. And only one of two things would cause interest rates to start, the Fed to start cutting. And that is another major problem, another break in the financial system, whether it's banks, broker dealers, municipal bond market, treasury, something out there. There's a lot of aspects, insurance companies, or we head into a pretty solid recession. The economy starts dropping off a cliff, in which case I struggle to see the positive for tech stocks. Tech stocks are growth stocks. They outperform in a growth economy, and I've heard, oh my gosh, some of the reasons that I've heard these permabulls come on and cite to validate how the stock market will continue to go up even if the economy goes into recession, some of which, but not limited to, that they've already priced in the recession, worst case scenario. It's beyond me. I'll just go back in time. You're not going to see, if the jobs market's finally, which has been the last pillar, the consumer's been the last pillar to roll over in this whole thing. You start to see the jobs market go off, unemployment start to rise. Remember, everything is a vicious cycle, and then you will see, everything else kind of comes into place. Housing market will go down. That's been held up. And tech companies are going to feel the pain a lot more than a lot of other sectors out there. All right, let me reel it back in, get off my fundamental rant. Again, I'm just trying to get my arms around how, and I kind of get it. I see their point of view is that this market has become so dependent on easy money and can rally at any reason they expect the Fed to start cutting rates again and giving them the juice back, the low interest rates, easy money. And again, we got it in COVID, but the economy, they forced a shutdown for a while, but the economy was on fire in a lot of places. Here, I can tell you, at Southwest Florida, every single person I know that owns a business made out, they were already having their best year as it was, and COVID didn't, and again, I know we're isolated. I know Florida's had more growth, and people left New Jersey, New York, and some other states, but around the country, and then, the government just injecting all that liquidity, giving everyone the PPP funds when they, whether they needed it or not, it's insane, and that's what brought us here. But what I wanted to show you now, let's get away from my fundamental rant. NVIDIA. Biggest semiconductor. This is a 110% breakdown today. There's your uptrend line, nice and clean. Lots of reactions along the way. Negative divergences, building. And this is why I've stayed persistently bearish and short on the semis. and now we have an additional check mark today. So there it is, breakdown on NVIDIA, the largest of the semis, and it's just a hair below support. If it happens to kick back and have a snapback rally, 287.43 is a major reaction high, and so far we've reversed a little shy of that. All right, Taiwan semi, well, that one peaked right here. Must have been earnings or something. That big candle peaked there. It's been walking its way lower. Not very much. Again, the semis, it's a slow roll so far, and you can't write them off. But again, it's another one below trend, and then it's another one stair stepping lower. Second largest semi. Broadcom, big resistance. That's that same March reaction high that I was looking at on NVIDIA. Major resistance around 644, and it's just capped this one. 1, 2, 3, 4, 5, 6. Going back since what is this first one? We're going back into beginning of March, and it's just hit a brick wall there. And you know, glass half full sees okay. It's a high level consolidation. It's been a hell of a run. Was overbought. And I will acknowledge that part of it. Everything needs to take a breather. It's more healthy if it consolidates before a breakout. But it's pesky little divergences, you know, that tell me that this thing, and it broke the minor trend line, and it's still, same with my update weeks ago, I said it needs to take out S1, support, first support, about 615.40. That should open a door for a move down to the first target zone, second target, third, fourth, fifth. And I promise you, if Broadcom does this, the Nasdaq's going down too. The semis are going down. It would be very, very unlikely to see Broadcom hit really any of these targets without the whole sector, because birds of a feather flock together. I have my, here, I'll show it to you. I've got, this is that new beta version. I don't know, where's my components. They see the old version had a component watch list here. Hold on one second. Oh, yeah, no, this is what I need to do. My bad. Come here to socks. Let's see, that should queue it up. At the personal watch list. Aha, there it is. That little box there. All right, I'm just showing you this is the Philex SOX, which is the original semiconductor index. This tracks that. Second ago we had all red. Now Symantec went slightly green. 0.32%, so almost flat. But you can see they're all down. And let me just show you a few more. Because one down day doesn't really change things. What changes things is, you know, these are playing out. This is when we first shorted them back. It was February 8th, maybe a little after that breakdown. And you know, a lot of these semis have peaked. And if now what you have here is an early making of a downtrend. You have a high, a reaction low, a lower high so far. So if we go on and take out that, then you have, this was an uptrend, series of higher highs, higher lows, and this is what I think is the beginning of a new downtrend. This was obviously a downtrend there, and so these are swing trading time frames. So this divergent high tells me that there's probably more to come, and that was a major end of a bear market rally right there for that stock, and so forth and so on. Texas Instruments getting hammered pretty good today, down to uptrend line support right here and price support. AMD rejected at the 99.61 resistance with negative divergence. So blah blah blah. Most of them had negative divergence. There's Intel hit that 333.32 target yesterday resistance, and that was where, if I owned it, if I still had it, I would have taken profits yesterday for sure, based on my outlook of the market and the semis. But we'll see. Okay, I just wanted a quick update because I threw out XLE. This is kind of like a longer term swing trend trade. I don't update it often. I haven't had until recently. I showed you the divergent low and oil hitting that long-term support on USO. I'm talking about that. And so there might be some confusion. You know, that was bullish. We reversed off that swing target from back in 2022. The 58.60 and uptrend line was hit first, and then 58.60 was the final target, and that was hit, and we rallied. Now we broke out above the downtrend line, so all that's bullish. So why would I highlight the XLE trade? That was back here. You had T1 somewhere off this divergent high. T1 hit, rallied back up, put in, still fell below that previous divergent high, And so we've been in a downtrend in the energy stocks, and this was solely technical, because you have a beautiful little uptrend line here. The purple was my primary trend line, and then the white one right here is a BOD, and you have the same low back in late October, early November of 2021. Major reaction low there, another reaction right there, and we're back testing. And I wanted to show you this. We hit T2, T3. I told you yesterday I removed the potential from potential T4. That is now official T4. I believe energy stocks have a lot more to go to the downside. I removed that. I just had a line through it in yesterday's post. So there's T4, T5, and I give you a new final target zone, T6 zone. If hit, that's going to be a drop of another 30, roughly 33, 34%. But what I want to show you is this. I've traded XLE and the energy stocks and the ETFs for years, and XLE is all it is two stocks really. I don't know if it's changed, but for years, every time I checked, over half of it, literally half of the ETF or more, was just two stocks accounted for, the weighting of ExxonMobil and Chevron. And so this is ExxonMobil. You see a lot of lines here. Let me just make it very clear. We've been diverging. That divergence starting to steepen here. Big negative divergence in this point. And again, it's not as if these divergences, that was the first divergent high correction. The divergence was extended, so DH2 really right here, right? And we'll call that 2. Bigger correction. Divergent high 3 correction. We went up and make a marginal new high. And so far, another big correction and just a beautiful back test. I only have a single uptrend line on ExxonMobil. Let me turn off all the lines and you can see it. And so where ExxonMobil goes, the energy sector goes. Okay, that's really, it's not that, it is that simple. This is the trend line I had. Okay, I had one violation here, but a lot of reactions on that trend line that I was just showing you. 1, 2, 3. Briefly through there, and then actually was right up under here. That's where I had it here. I'll turn it back on so you can see it. That's it, riding up there. So we back tested, we broke down, and this is a back test. And then on Chevron, you have the same thing, an even cleaner trend line right there with no violations. 1, 2, 3, 4, 5 distinct reactions right there. Breakdown, we back tested for a little while, ran down, hit a very, very good support zone, bounced, gave us this kickback rally, and we are back testing from below. So this is my projected path for Chevron. And again, it's one trade of many. I don't have a ton of money in it, but I didn't even have it until yesterday. I added on the breakdown. I had it short before. I've been out of crude, and I haven't given you many updates until recently. I told you I took it a couple weeks, a week or so ago. We put in a nice divergent low on the 60-minute chart of crude futures. We also hit that level on USO. I have no positions in crude oil right now, and really not a strong opinion on where it goes. But these are stocks. So even if crude were to hold up and we get a hard down in the equity markets, they will most likely get sold down because they are S&P 500 component weighting. They're big, big components in the S&P 500. Lights out for Chevron is going to be below this level right here. You've got a potential big topping pattern. It's about 149 or so. And, it's these weekly charts. This is clear. This is a very clear, clean chart to me. There's a primary uptrend line off the early 2020 lows. Tons of reactions, clean, no violations, my kind of trend line, breakdown, and a back test. Okay, and negative divergence on the weekly to boot. So anyways, last time we had divergence on the weekly right there. We had a small divergent high. We had a correction back to the trend line. Time before that was right here. From that point, that was about 135. Chevron fell 61%. So just looking at this weekly chart, where's it going? Right here, at least back to 135 minimum. If things get ugly, probably come back test this trend line down here. Okay, on a related note, yesterday somebody asked me about natural gas, and I gave them this chart. And then a couple folks asked today, I just posted a link to this. This is the hourly chart. Remember, we're getting very, very low down to, about as close to, there's no hard bottom on natural gas, but we're down to where it typically falls to over the last couple of decades. You have a downtrend line, and I said a break of the downtrend line could trigger buy signal, but this would be really a much more powerful signal. It's about 225 right there. You have this reaction low. We had a divergent low there, only on the PPO, but you got a nice rally and pulled back, tested, boom, that support broke. And once it broke, here, I'll zoom in for you. You can see we back tested it from below. Boom, boom, almost there. Another one, perfect back test. And so this level, I think nat gas will most likely pop and run. And that's again about 225 on the futures, minimum target. You can see each target's marked 239, 251 ish. But that would be a minimum target there, and again, there's potential for bottom there in natural gas. So anyways, that's that update there. And again, the whole that whole, I know there's some disagreement on the site. I believe and I've maintained emphatically and persistently that we're in an early stage new bull market for commodities following a vicious bear market that's started back in 2008, and recently we pulled back to what I believe to be an excellent buy point for DJP, of one of the most well diversified commodity ETFs out there. 38.2% retracement right there of the entire move right here from the lows to this rally right there. So in a bull trend, when you're in an uptrend and you have a correction, corrections will typically be contained by a 38.50 or the 61.8 fib, somewhere in that range. And this happens to be price support as well. You had a major reaction low there back in 2008. You have broke down there, gave up that level, back tested it perfectly from below, got rejected, and fast forward, rallied up to it, got a hard rejection off it there. So all these levels that I just covered validate that as an important support level. And then boom, we just hit it again, and so far we bounced. All we need to do now is pop this trend line, and that should be bullish for commodities. And the stock market will not like that, because then that forces the Fed's hand again. It'll be the return of inflation. And that's what it looks like on the daily chart. There's that same trend line. We need to pop that. You have price resistance just above it, about 32.41. You can call it 32.50 if you want to be safe. Divergences tell me that that's the most likely case that we will sooner than later resume the uptrend in commodities. And if so, then that whole vicious cycle that I've talked about, where and this is how and so far to the T, this is how it's played out. We have these stock market rallies. Every time there's a belief, again, it doesn't have to be an actual cut or reversal in interest rates, just a belief. And that's what made this bear market so far has been just a ginormous dichotomy between what the Fed is doing and saying to what the market believes. And so, like, again, this last Fed meeting where they hiked another quarter point, said they might probably do another one, he's going to stay hawkish. And they even, in the press conference, even said, hey, the Fed fund futures, the market doesn't believe you. They're pricing in a hard down. You cutting rates, after, it's starting in a couple meetings and whatever. I'll tell you this. Powell doesn't know. Powell, first of all, pardon my French, is an idiot, I think. And I've said that. I've been critical of him and the Fed. I really, truly believe these people do not know what they're doing. Same folks that are supposed to be, keeping on the banks. They had no idea about Silicon Valley. They had no idea that I didn't know what, that the banks were market, that they had securities, that they, treasuries they could mark to maturity, play that little game to hide the losses, just mark them to maturity. But then when it's convenient to make your books look good, if you, had the bond market rallied over the last, few months and they were profitable, I guarantee all those would have been marked to be sold, or whatever they call it, marked to, where they're not held to maturity. And that's, again, that's what's caused the problem since the financial crisis back in '08, where they got rid of mark-to-market rules in a lot of industries, and it allows for it's tantamount. It's almost fraud, really. It is, and it's cooking the books. And then again, my point is, how did the Fed not know that? And then all of a sudden, okay, they conveniently deem Silicon Valley too big to fail, and it just shows. I mean, the credibility of the Fed in recent years, especially creating this inflationary bubble, was bad. And now it's only, I think the Fed has zero credibility. And I've always said this, the Fed, no matter what they say, I put zero into what the Fed says they're going to do, what they're thinking about doing. I can tell you before the Fed can what they're going to do based on what the market and what interest rates do. It's easy to call when they're going to have to. Finally, I didn't know it would take Powell so long to pivot, but I knew he would pivot and go to hawkish and start cutting rates eventually, because this is when we're talking about back here. There's a real-time inflation indicator. Transitory. It was transitory for him up until about somewhere in here. And then he acknowledged that it wasn't transitory anymore after commodities had rallied 120%. The housing market was soaring, and oh gosh. Anyway, so all right, guys, that's the outlook, and so these are the things we look at, and this is again the bigger picture. I think has been, and I think will be for the foreseeable future, is just trading and trying to get in front of that vicious cycle between inflation, interest rates, and again, more so whether it's real or perceived. Again, that was a great example. The last Fed meeting, the Fed saying they were going to continue to stay tight and hawkish, and the market saying, oh, the 180 degrees opposite, pricing in rate cuts. Yet, and their stocks rallied on that. And so, if the market is right and it proves to be, I think it's a kind of that heads I win, tails you lose kind of thing for the stock market, because if they're right and there's some Fed and some significant cuts coming, again, the only way I can see that is because the economy is taking a much sharper turn than expected. And that whole soft landing thing is out of the question. It's going to be more of a hard landing, or something big breaks in the financial system, or a combination of both, probably interrelated. I think I'd like to, on a final note, I'd like to believe, although I struggle with it, because for so many years the Fed has just done the wrong thing, and historically they're always too late to raise, too late to cut. They're always behind the curve. They're always reactive, not proactive. But I would, in my heart of hearts, like to believe that Powell is not an outright idiot, and that he has now realized the danger of keeping rates artificially lower than they need to be despite a strong economy for too long. And so what I would like to believe, right or wrong, is that the Fed has been able to at least somewhat normalize rates. Remember, we're still historically low, historically, not last 10 years, but going back over time, we're back historically low. Interest rates are. You look at the 10-year bond or whatever you want to look at, and there's TNX, or the yield of the 10-year. So, and I would like to believe that unless there's a very, very compelling reason to cut rates and cut them substantially, where it's going to, again, just any reason to cut rates. I think Powell and the Fed will have acknowledged that, we've normalized rates. We've got a little bit of a buffer now. Let's maintain that buffer. Let's hold the Fed funds rate and not cut unless we really have to prevent some type of economic disaster, some kind of big failure in the system, even if it means taking a little pain with a recession, which he's acknowledged they'd like to do. So it's my belief that the only way rates are coming down, because remember, the Fed has now just gotten back to still historically low, but a somewhat normalized interest rate environment, at least on the short end. Of course, the yield curve inversions and all that other stuff. And so that's my take. So I just, again, to me it's a heads for the stock market. Heads you lose, tails I win kind of thing. But but who knows? I've been wrong before. Maybe I'll be wrong again. So that's a lot of fundamental ramblings, but it does go hand in hand. Interest rates and I told you the bond yields. That's looking like a nice trade right now. Yields up, bonds down. Still looking for a likely pullback in bonds. Let me show you one more chart, and then I'll shut up. ZB. This is the 6-month. This is the 30-year bond. That's resistance. Big resistance. Look at that. Boom, 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 boom. Right? Negative divergence at that high. That's what happened. Negative divergence at that high. Nope, I'm sorry, no divergence. But it was resistance. We had a little rejection. There you had the divergence. I don't know why. Things just kind of vanish sometimes. Roughly equal highs. That's maybe why I didn't have it drawn out. You had roughly equal highs, slightly lower, but for all intents and purposes, that's an equal high and divergent high, and then boom, right? Oops. So divergent high at resistance, divergent high, rally into resistance, divergent high at resistance, nice correction. And now, and even this is DH1, now DH2. And there's a minimum target would be a pullback to this trend line, and if that trend line's broken, could send us a lot lower. So that means yields higher, bonds down. It's also, I'm viewing this, I took for the first time, and since, my time frame is very short, first time in a little while, shorted ZB, took a starter short for this reason, at resistance. Big negative divergence. It's also a hedge right now. I'm viewing it as an indirect hedge to my index shorts. Why? Because normally bonds rally when stocks go down. And so if that's the case, and I'm wrong and the stocks start going up, bonds should go down. And so I should profit, theoretically, by that logic, on my ZB short. And now, if I'm lucky, I could see stocks go down and bonds go down as well, because we have seen since the bear market started an unusual but pretty persistent positive correlation between stocks and bonds. So again, I can think through it all day long how, from a fundamental perspective, why bonds should rally if the stock market's about to take a hard down in the coming weeks to months, as I expect. You should see a flight to safety in treasuries, and you might. Look, this is a big resistance level. Again, it's not all or none, it's incremental. We start getting away from there, especially if this divergence gets taken out, and bonds could really continue to rally hard. But as of now, I just want to point out, I think it's an objective short entry. We're right at resistance, very right on that top of that resistance zone, and looks like an objective short with stops somewhat above, again, depending on where you think things are going. Okie doke. Let me wrap it up here. Again, as I started the video, we got key support right now on the Nasdaq 100. And I'm waiting to see if and when that goes, 313-ish, 312, like I said, and that would be your next sell signal, and a pretty powerful one. And again, based on the divergences, it appears to me to be a matter of time, but there are no guarantees. Support is support until unless broken. All right, guys, I'll wrap it up here. This has been Randy Finney with the Right Side of the Chart. Have a great day.